Following the past calls in September, my guest today, Michael Campbell, recently promoted to the CEO position at the Carlton Group, has some pretty big shoes to fill. As you'll hear from today's conversation, he is a great choice for the role, and while skeptical, continues to keep his eye on crowdfunding. Welcome to the National Real Estate Forum.org podcast, episode 240. Thanks for joining me today. I'm Dr. Adam Gower, and this is the National Real Estate Forum, where I speak to the leaders of the real estate syndication industry so that you can learn about trends and practices in real estate investing and how to raise capital online. Having been hosting this podcast series for 2 years now, I'm about to give the show a new look and some new branding. It's about time for an upgrade. I'm having a lot of fun putting it all together and completing some free ebooks on real estate syndication, also known as crowdfunding, that I'm going to be sharing with you to coincide with the launch. So be sure to be among the first to get them when they're published. Just go to the National Real Estate Forum website, nreforum.org/Carlton Group, and sign up for the News Digest at the top of that page, because that's where I'm going to announce the rebrand first. And it's through the digest that I'll send out the ebooks. All right, so that's nreforum.org/Carlton Group, and subscribe to the News Digest at the top of the page there. I first came across the Carlton Group around 2008 when I was brought into East West Bank to help clean up their balance sheet during the Great Recession. And I've stayed on their email list ever since then, tracking what they do with considerable interest. Their deals are massive. I'd say for me to speak ever since then, tracking what they do with considerable interest. Their deals are massive. I'd say just stratospheric scale Carlton Group, really amazing. So it was an enormous pleasure for me to speak with Michael Campbell and to learn firsthand what they do and how they think. And hearing Michael, you'll realize why he is not only one of the top professionals in the real estate industry in America, but why Carlton Group has reason to be very confident in their new CEO's capable hands that its future is brighter than ever. Here he is, Michael Campbell, the new CEO of the Carlton Group.
All right. Well, my background is, I've been in real estate since I graduated, since college. Being at Carlton, this is only my second job I've ever had. My first job, I worked for Prudential when they had a realty group, when they used to own real estate. And, I was involved in the principal business of real estate at Prudential. And then I did mortgage loans for Prudential for about 4 years. And then I came to Carlton, and I've been here almost 20 years. And pretty much what I've been doing at Carlton is really focused on raising JV equity and debt for real estate deals, typically on the larger side, of deals, but, it's, hotels, office buildings, recapitalizations, like partner buyouts of deals, developments, you pretty much name it. We've done it over the past 20 years. Typically, like I said, typically on the larger side, that's our thing. But we do smaller deals also. It's just, for us, it's just the same amount of work to do a big deal than it is a smaller deal. So we really do the bigger deals.
Right.
And I met Howard, in terms of Carlton, originally, Howard started Carlton, Howard's now, passed away, but, I'm running things now. But, originally was started as an auction company, in like 91, we're doing, and then in 98, Carlton sort of changed its focus to doing, JV equity along with the debt. Because, at that time, Carlton realized that what the world didn't need was another mortgage broker. So we had to figure out a way to, we had to figure out a way to sort of make us a little different than everyone else. So in 98 is when we sort of changed the focus to JV equity, and that's when I came on board. And, throughout those years, been, pretty much doing JV equity for trophy deals, like we did the recap of the General Motors building for Harry Macklowe. We recapitalized Sears Tower, now called Wills Tower, for the owners, before they sold it to Blackstone, because Blackstone owns it now. Mm-hmm. And then we brought in equity for our clients to buy the Bank of America Tower in San Francisco. And then 18 months later, we brought in a buyer of the building to buy it from them, who happened to be, Trump, along with his Chinese investors. And then I think they still own that building as far as I know. They still own that building as far as I know. But it was like a 1031 exchange that they did. We brought them in to recap that or sell that deal, so to speak. But that's sort of how I got involved in what we do. But like I said, our focus is JV equity.
Okay, so let me ask you then, because my focus is on Jobs Act regulations and how that changed the world. So before we get into that, can you help me understand what is the difference between JV versus investor equity? What is the difference between that?
I mean, typically, we bring in an investor typically who invests 80 to 90%, and it usually comes from one investor. It could be some sovereign wealth fund or some off the radar, high net worth guy, family office. It's typically one investor. They put in 80 to 90% of the deal. Investors, typically usually means like you're syndicating it out to a bunch of people or investors. So you may have if you need $100 million of equity, one guy puts in 10, one guy puts in 30, one guy puts in 50, and one guy puts in 5. We don't do that. That's more like syndicating. That's, we bring in, someone to do all the equity, and what they are is they're like the entire LP. They're joint venture partners in a particular deal. They're buying an interest into a real estate deal. And our sponsor, puts in 10 to 20% of the equity, and after certain returns they meet, on when the deal happens, they get a promote. So the LP investor is rewarding them for doing a good job and meeting their pro forma and doing all the day-to-day work. And everyone's happy because everyone makes the return that they want.
Right. Now, you said that you didn't do investor equity, but don't you have a crowdfunding platform as well, Michael?
Yes, we do have yes, that's right. And that's where it gets into your Jobs Act question
right
a second ago. But we do have a crowdfunding site, where it is individual, where it is individual investor equity, where they do put in $250,000 or so per each. And we tend not to focus on the $5,000 to $10,000 or $20,000 per person investors on the crowdfunding site. Typically, it's $250 and more. And that said, though, we probably have done 3 or 4 deals where we raised. For example, I did a $55 million hotel deal portfolio in North Carolina, like Charlotte and the Raleigh area last year. We brought in investors from the crowdfunding site, but for us, it's still not big enough. I mean, until we can get to a point where we can raise substantial amounts of money, it's really we found that it's become too cumbersome. Unless you're like a shop that that's like manufactures deals every day, you're raising money, where it's like a manufacturing line, it's probably easier to do. But for us, or deal and mentoring line, it's probably easier to do. But for us, when we take on a deal, we sort of focus on each deal, and it's just hard to raise $5 million for a deal and make any money. It's that's not our focus, and so now we've sort of gone back to focusing more on raising equity individually. Well, we never stop it actually, but we sort of focus less on the crowdfunding than we were 2 years ago, for example.
That's interesting. So when you say raising equity, again, this is JV partners, is it? The ones that come in with the bulk of the capital needed in a deal?
Correct. 80 to 90%.
Right, that bring 80% of the equity that's needed.
80 to 90%, which is the bulk of it, right?
Right. So you have the bank debt, and then you have the equity. The people that you bring in are the ones that bring the 80 to 90% of the equity, and then the sponsor will retain the rest.
Correct.
Right.
And we still do the debt. Just people rarely come to us just to do a loan. They come to us, they want the equity, and the debt comes along with doing the deal. Because we raise the entire capital stack aside from what the sponsor puts in, himself.
I see. And then, so I tell you what, then because if you don't mind, Michael, let's just focus a little bit on the crowdfunding side of it. And I am interested to know why you've backed away from it. But what was it initially that was attractive to you? And how did you come across it anyway? What kind of motivated you to even try it?
Because, they changed the laws. So basically, it's like it's the Jobs Act. When that happened, it opened it up for a lot of, investors and websites, basically. It's more of a technology aspect for individuals to invest more into real estate easily. or easier. So it's we thought it could have been an opportunity, and it is an opportunity for some groups. So some of these crowdfunding groups are very successful in doing, or some of these crowdfunding groups are very successful in doing this, but that's all they do 100%. They don't have it as a side business. And for us, it was more of a side business. And to really make it successful, you have to put a lot of time and effort into it, which for us as Carlton right now, even then, we were making, lots of money doing what we did before. It didn't make sense to sort of put that on hold, stop raising $100 million of equity for a big deal and start raising, $2 million, for a small deal. Even though you can do it multiple times and maybe a little bit faster, it just wasn't enough volume for us personally, to make, the money that we're used to making by doing crowdfunding deals.
And you don't think it's something that has the potential over the longer run to be of a similar scale to the kind of institutional scale that you currently engage in?
100%. In the future, it sort of focuses more. It's going to be definitely an aspect. It's not there yet. I think there may be one company out there, that sort of focuses more on the institutional investors doing it through the crowdfunding type of business or platform or technology-based platform. But right now, it's not really there. And it's, for the bigger deals, because right now, if you have a $1 billion deal, no one's going to invest over the internet. It still takes a bigger, personal relationship.
Click here.
Right. We don't want to have that click like on Amazon where you buy something so quickly, it's too late. People aren't going to do that when it's a $1 billion deal. So you said that, that personal aspect of it, which is what we, we thrive in, and we like that. And, eventually it will become more technology based, but in the end, I'm never really going to see, I don't think, a huge deal getting done through the internet without a lot of relationships and, personal interaction.
For investors so that you can, prepare them for the long run. So, for example, giving 85% of a deal to one of your usual investors and then 5% to the crowd. And then over time, developing the relationship with that smaller group.
To be honest, actually, the deal I mentioned in North Carolina, in Charlotte, in the hotel deal, that's actually what we did. It was a $55 million deal. And I think, I'm trying to think of the numbers exactly, but it was around, I think, $2.5–3 million were raised through crowdfunding. And then we had a fund from the West Coast, do the balance of the equity, and the sponsor put in their equity. Then the balance was, debt. So in that scenario, we did, lay off some to a crowdfunding, and gave some to an institutional investor. So we did do that, and we will still do that in the future going ahead. But I would tell you, it just takes sometimes it's just a lot of people, and a lot of people in the mix.
How did you structure that? Actually, I mean, how did you actually execute on that with the smaller investors? Do you have people in house, or did you farm that out to a platform somewhere? How did you?
No, we did it in house. We were running our crowdfunding site, which we still have it, and we still would use it. We're not active on it as we were, but we did it in house. And we had a few guys here that really focused on trying to find the $250,000 investors, to invest, and that's what we did. It was all done in house. We didn't outsource it to someone else.
Oh, okay. And you had some of your in-house people trying to source those accredited investors.
That's correct. Yes. Go to the National Real Estate Forum website, nreforum.org/Carlton Group, and sign up for the news digest at the top of that page so you can be the first to hear about the show's rebranding and get access for the free ebooks on real estate syndication that I'll be publishing. That's nreforum.org/Carlton Group.
Interesting. All right. Where are we in the current cycle? In the real estate cycle, what are you seeing, Michael?
I mean, it's a strong market, obviously, and things are, the economy's doing well, and it's deals are happening. Some of the groups are pulling back a little bit because they're being cautious. They're not being as aggressive. Maybe they want to do lower leverage loans, but what I do see is I don't see a lot of or haven't seen a lot of deals, and we haven't done a lot of deals, or any deals actually, which were highly levered. When something before, in the last cycle, it was very easy to get like a 90% loan from Wachovia or someone like that, who's now out of business because you go over 65% loan from Wachovia or someone like that, who's now out of business because they're doing 90% loans. But it's,
exactly.
But now we're hard pressed to find someone to go over 65% leverage, which means we got to find a preferred equity guy or bigger JV equity guy, which makes the deals a little bit more secure in terms of something happens. So I think people are prepared. Everyone keeps saying that we're at the peak. That's also what they said last year. And this year it keeps getting better. So it's to a point. It's going to be there's going to be some type of correction, but I don't think it's going to be anything major that's going to upset the market, so to speak. But because I think we're well structured in real estate deals now to have any type of catastrophe. I don't see that at all. But and that's it's cycles. That always happens.
And you think that the security comes from having less leverage in the market?
Yes, this way, there's less leverage. There's less leverage. So the equity may have to stay in the deal a little bit longer until things come back potentially. But this way they don't have to worry about paying off a loan that's due. That's like highly levered. They can sort of withstand any any downturns. If there is a serious downturn, which I don't really see anything serious, but obviously things. Who knows? But it's right now things are strong, and there's plenty of money out there, at least from our perspective. Especially from the foreign guys who are still looking to do deals in the U.S.
And then presumably, because there's lower leverage in the market, you're also seeing lower returns, lower projected returns and yields. Is that fair to say?
100%. That's exactly right. Yes, definitely the returns are lower, and they're lower for one because the leverage is lower, but also then the pricing had been kept creeping up also. So the returns are lower, but people are okay with that because they don't feel. I guess the scenario when people say they can sleep at night. That's sort of they really make a little bit less money and be able to sleep at night. So that's sort of how most of the deals that we do, if not all of them, are structured so that it's not something they have to worry about the market changing and they're going to be in trouble. If the market changes, they may have to wait an extra couple of years before they make their return. But that's sort of how we like to do it. Be able to sleep at night is important to these investors.
But they won't lose their principal, right? That's the point.
Right. But that's the goal, right? And maybe there could be a few years where it's structured where they don't make as much a return, or maybe zero return for a couple of years. Who knows? But at least they won't lose their principal, and they'll be able to withstand any downturns.
So at your end of the market, and I you're clearly at the extremely high end of the market. What kind of returns do you see? Yeah, what kind of returns do you see, or what kind of range of returns do you see, and what kind of deals do those apply to? You've described.
Okay.
Yeah, go ahead.
We're sort of described the range. Obviously the safer property types that investors are looking for is multifamily rentals. We're doing a few value-add multifamily rentals now, various parts of the country, and and those deals pan out to mid to high teens, like say 14 to 18%, so to speak, is the the returns they're expected to generate. If it's more of a core-ish type of multifamily, you're in the low teens, say 12%, IRR. And if it's a development deal, it's 20% plus IRR, for multifamily. And that sort of goes towards, hotel deals. We're still seeing deals that are projected, 20 to 25%, returns, because the hotel is people view as probably more as a riskier property type of the group, aside from condos, which are also ours, the riskier aspect. But, some cities, condo market is still very strong. We're doing deals in Seattle and, California, this still makes sense. And those deals are making, 25% IRRs, and they're still selling, there's still velocity. I mean, the condos that get hurt the most in New York are really just the $10 million plus condominiums, what they call, I guess, the Billionaire's Row in Manhattan. But there's still plenty of deals, which are still happening today. If you look at the price market, the price per unit of a condo today, the $1 to $2 to $3 million range, in New York, that's like small. The rest of the world is probably expensive,
exactly.
but New York is like a small deal.
That's a studio.
Yeah. Right, exactly. And there's a lot of people out there. There's still a lot of velocity for those type of deals. So we're still getting deals done where the ultimate unit price is $1 to $3 million per unit, because that still sells. $10 million units are hard to sell because it's a different market, and it's, that's the ones that are harder to capitalize unless you have a great project. And there are some great projects, with which they're going to have, the $10 million, and up, units, but they're irreplaceable locations and they're one of a kind. The fringy deals, those are the harder ones to capitalize in New York. And then, like I said, outside of New York, there's, we're doing other condo deals in Seattle and California, which are on the lower end of pricing, and there's still buyers for those condos.
And what's your minimum deal size, Michael? What do you like to look at typically?
I mean, typically, obviously we do big deals. That's our MO. But typically the minimum deal we would do is probably like $50 million, where we do the equity and debt, and we have done lower. If it's an easier deal, we think we can get it done quickly, we could do a lower deal. Or if it's for an existing client, we would do a smaller deal than 50. But typically, we tell people who come to us for equity and debt is $50 million is our minimum. But that said, though, it could be 40. If we can still do it. But the bigger the better, because the way we look at it is, it's just as hard to do, or same amount of time to do a small deal than it is a bigger deal. And so I really do the bigger deal because for us, we're everyone makes more money, and that's really what it's all about.
So you've actually said something quite interesting. When I asked you about the different types of deals and the different kinds of yields, you pointed to multifamily and hotels. Yeah. Earlier in our conversation, you talked about some of these incredible, what are they called?
Oh, the trophy deals.
The trophy deals. So from the way you've described your business, it sounds like you had some, it seems to me that your primary equity JV partner is going to be more conservative than looking at a multifamily development deal somewhere, that they're going to be looking at trophy properties. Is going to be more conservative than looking at a multifamily development deal somewhere, that they're going to be looking at trophy properties. Presumably the yields on those are significantly less than multifamily that you described, right? How do those deals 100%. Work?
Typically those deals, like if you're buying a trophy hotel even, or a trophy office building in Manhattan, you're paying a 4 cap, and you're going to make, if you're lucky, 10% return over the investment horizon, probably lower. But, for the foreign groups that we deal with, for those type of deals, they don't really care about return as much as, someone that's more domestic focused. The most domestic located, because they're looking for one safe haven, which I'm sure you've heard a million times. Everyone's looking for a safe haven in the U.S. But typically the trophy deals, that we do in New York, in LA and San Francisco, they're big. So someone from a foreign country can write a big check, and that's really what they want to do. Eventually, these are going to be, doing very well on a cash flow basis, because they're always going to be leased and have tenants, and so it's always going to be very well. So if you have a long-term horizon, which a lot of these foreign groups do, they don't care, because they have a safe trophy assets, and in 10 years they'll be making a lot of money then, and they still have this trophy asset, which they never, that's hard assets, and in 10 years they'll be making a lot of money then, and they still have this trophy asset, which they never really want to sell. That's how those deals get done. The trophy deals in America don't get done by, the funds, that the private equity funds, and, that's hard for them to get, they have mid-teens, return hurdles for their funds, so they can't do these types of deals.
Interesting. And so let me ask you, let's kind of pivot a little bit. This is clearly off the list that I sent you, but only because our conversation is diverging a little, and it's fascinating to talk to you, Michael. When you do a deal with a sponsor, and not just a straight acquisition, but when you do a deal with a sponsor who's doing a value add, perhaps, or a ground up deal, what are the key terms that you look for in the offering, to the relationship between the sponsor and your JV partner?
The key that we look for before we want to take on the assignment, or what the key things the investor looks for?
Yeah, investor. Yeah.
Okay. Yeah. Well, the investor is, when we bring a deal to the investor, they're a limited partner, or a limited, LP partner, JV partner, and my sponsor does day to day. So pretty much they always ask, or they want to know, what the sponsor has done before, what's their track record. Can they handle this type of value add or ground up development? Because, for investors that we bring, either they're probably, 5,000-10,000 miles away, or they could be here in the U.S., and not have real experience doing this deal themselves, but they want to invest in real estate. So half the battle, if not more, for the investor is really just making sure they're comfortable with the sponsor who's going to be running the day-to-day. Because if they don't trust the sponsor, or they doesn't have a track record, or they don't believe his plan that he can actually have the best located property wherever, they're not going to invest with you if they don't like the sponsor or they don't believe in him. That's really the most important feature. And then, if they get comfortable with the sponsor, then the location and the returns, that's what they ask for next, to get comfortable with. But the sponsor aspect is, the most important feature for the investors.
Any kind of terms in the offering documents, kind of key drivers to investor decisions once they start drilling down? I mean, you must have seen a million negotiations, I imagine, over these things. So what are kind of the key trigger things they look for?
Right. I mean, so someone's going to bring, 80 or 90% of the equity. They may be a limited and you're going to run day to day, but, they pretty much still can call the shots, so to speak, on a macro basis. So whenever there's major decisions and, or if you're off budgets, the investor, our investor we bring in, has to approve it. If you want the investor, our investor we bring in, has to approve it. If you want to refinance the property, take on this loan and, or do a big lease, that's, could be, a big piece of the income. Our investor has to sign off on it. They don't have free reign. So it's not discretionary 100% for our sponsor, because, our guy is actually putting in most of the money. So they have the ability to call the shots like that, but it's also a give and take. They have to have, the sponsors don't want to have someone, breathing in their neck every day. There has to be some trust there that they can execute it. And typically that's what it is. It's really trust. And, if the guy is a great sponsor, they would usually go with his decision. But they still have the right to say no. And if there's ever a disagreement, there's always, a buy sell where they can buy out our partner, or our investor, or our investor can buy out the sponsor if they feel like they can do it themselves or bring in another sponsor. There's always a buy sell to alleviate any issues, on this major decision component.
Interesting. And you do development deals as well, do you? Ground up? You finance
100%, yeah. Yeah,
really?
We do a lot of it. We always do, depends on, we do whatever the market's doing. For the past couple of years, there's a lot of condo ground ups. We did a hotel here in Manhattan. We did the Edition Hotel in Times Square. That was a ground up deal, which is popping out now, I think. Now we did a few, condo towers downtown Manhattan, doing one now in Seattle. We did one in West Hollywood also, an Edition Hotel there, and condominiums. But ground up is a different investor. Typically, investors who will invest in a ground up deal aren't the investors who are going to be doing a recap of an existing deal. It's someone who has a risk tolerance. Investors who have, they want to do cash flowing deals and make a lower return, but save for having cash flow. They typically aren't going to be doing a development deal, which obviously is riskier, but you have a potential to make a lot more money. But one or the other. Typically, the guy doesn't do both.
And
the investor.
Yeah, and typically in a development deal, the investor has to wait before they see any kind of returns or yields.
That's right. They're basically fully IRR driven. There's no return until it's leased, and either they sell it or it's leased. If it's a rental building, sometimes you have to wait two years before you get any income. You lease it up, then you refinance it at that point if you're going to hold it long term and take out some of your equity, and then you have a cash flow, or you sell it. Which is basically a total IRR deal for the investor. But it really depends on what the sponsor and the investor agree on what the business plan is. That's a good point. Also, is typically when we bring the investor in, the sponsor may already have the mindset that he wants to build something and hold on to it long term. So we bring an investor that has the same mindset, that also wants to build and hold on to it long term. But sometimes our sponsors want to build it and then sell it right away, and we bring investors that have that same mindset as well. So that's sort of what we do as well, match make the right investor for the right type of business plan as well.
And to what extent does Carlton Group do or get engaged in any of the due diligence?
We work with we're hired by the clients, to sponsor. We work with the investor to provide him all the materials that they need to underwrite a deal. Initially, we give them everything that they need or need to have to make a decision to, that they want to do the deal. But after, they decide they want to do the deal, there's still a period of, say, 30 days or plus or minus, where they would hire a third-party consultant like an E&Y or someone like that to go through and just verify all the numbers that, were presented to them. And that's something they do, with the third party that we're not involved in, because we want to make sure that they really check it out and they make a right decision based on numbers that they had third parties verify.
Right. And you represent the sponsor anyway, so you have a fiduciary to them, presumably.
That's correct.
Fascinating. What are your biggest challenges at the moment?
A lot of times, because we raise equity, 90% of the equity sometimes. Sometimes we get a lot of dreamers that come to us, want us to help them raise money for their deal. So one of the challenges, it's really true. You'd be surprised what, people want to, they want more money for. So it's the challenges, to make sure the guys, my guys here to work for me, when they get new guys here to work for me, when they get new business, I don't want them taking on deals that's going to be a waste of time.
Right.
Because we do get a lot of deals which could be potentially a waste of time or a low probability of happening. And time is money. We don't want to spend a lot of time because we don't get paid anything unless the deal closes. We don't charge any retainers, none of that. So time is totally money for us. And if we waste 3 months on a deal and it never happens, we lost 3 months of making money on another deal potentially. So we have to be very careful that we take on deals which are good deals, good sponsors, and that we feel that we can get closed. So that's why we have a very good hit rate, because we're very picky about what we do take on. We're a boutique shop, so we have 32 brokers in total across the country. In Europe, we do a lot of volume though. That's why we do big deals. Because we get a lot of volume. $5-10 million a year, because we do $1 billion deals at a time. But we have to be picky when we do deals, just to make sure that we don't we have to be picky when we do deals, just to make sure that we don't waste our time. That's one challenge. That's probably the biggest challenge actually we have.
It's really interesting that you should say that. How long does it take to know if somebody is real if they bring you a deal that's $500 million project? You got to be able to figure that out pretty quickly. No.
Right. If it's a reputable client or someone that's known in the market, that makes it easier. But if the clients, a lot of times people could come to us with a dream and an idea and not have control of the contract or the property. And so, a lot of times we do that for clients who have good reputations or have a good shots of getting a deal, especially if it's big. Because we've done it plenty of times before when people are bidding on deals. We help them, capitalize, bring their partner in so they can be stronger at the bid process. We do that all the time for good sponsors. But then we also get these guys who come in who have this deal, which is, it's off market and which is great, but they don't have it tied up. There's no contract, and you could potentially waste a lot of time because the seller could sell to somebody else. That especially if it's not with the broker. It's just, we have to be careful about that, because let's say have it tied up or have a good chance of tying it up. You could potentially waste, weeks of, time, dealing with these people.
All right. So let me just wrap up then before I ask you my 3 final questions, and then we can chat for a couple of minutes. Let me wrap up with a final question on crowdfunding again. Do you think that look, this is obviously a very loosely used term, but equity crowdfunding in the way that you've experimented with it, do you think it's something that you will be revisiting at some point? And what would be the kind of trigger that would start that off again if you were to do it?
I think we have to be, us start seeing, CalPERS and CalSTRS, investing a couple $1 million each into a crowdfunding deal that's when it becomes interesting, because you're getting into the ballpark of, of the deals that clients bring to us for equity, and then it also is in the ballpark of the amount of equity we like to raise on the deal. So once that starts happening, where we have the big institutions or big investors, doesn't have to be an institution, it could be, whomever, but that once we start seeing them investing bigger checks, individually, per piece into a crowdfunded deal, that's when it triggers for us, we should reevaluate. But right now, when, $50,000 investors at a time, it's really too much. It's a lot of effort to raise, $5 million if that's the case.
And is there any resistance from your JV partners if it were no effort, right, for you? There'd be resistance from your typical JV partners to having 5% go to a crowd of investors, smaller investors?
I don't think so. I mean, I think not for like 5%. I mean, it's our guys from, the big guys who are coming in and writing big checks. Their big issue is going to be, they're not going to want to be a non-controlling party, below 50%, in case something, goes awry. They want to make sure that they can, take over or do whatever they want, because if they have a lot of money, they want to make sure that they can make decisions. They wouldn't want, a crowdfunding group to be, I don't want to say, maybe voting rights not the right word, but have say so in the decision of the deal. And a crowdfunder is, it's 5%, but it could have, 50 investors in it. They don't want the decision of their investment to be based on those 50 people. But I think as long as it's those 50 people in the crowdfunding piece, but I think as long as it's a smaller piece, like you said, I think they wouldn't have any problem with it. Actually, there shouldn't be, like the one we did in North Carolina, the hotel deal has a small piece, and the institution had over 50%, so they had no problem with it.
Interesting. Michael, it's just an extreme pleasure to talk to you. I'm really, really thrilled and very flattered that you took the call, actually, even though I've spoken to just about everybody in the industry. I have been getting your emails for, over 10 years already. Let me wrap up then, if you don't mind, with 3 questions that I'm going to put into a book that I'll publish, hopefully by the end of the year if I can find the time. So the 3 wrap-up questions are: what are your key daily habits, personal habits, that make you productive and successful personally?
Okay, so I mean, the main thing is read everything, because information is, knowledge is power. I mean, in our business, when we're talking about markets, investors, sponsors, deals that are happening, you have to read everything. We right now we subscribe to every publication you can imagine. So it's like, every morning, before I even leave my house, I'm reading the email publication that are sent out pretty much on a daily basis to see what's happened that I may have missed yesterday. So to make sure I know everything that's going on, because we know people, when our clients come to us, they want to make sure that, they come to us for market knowledge also, not just for money. And we have to know the markets, that our clients are in. So I got to make sure I'm up to T on that. And the other thing too is, I write down ideas a lot. Sometimes when I, at home, I have a notebook by my nightstand, which I read in a book years ago that you should do that in case you have ideas in the middle of the night. And I do. And sometimes when I'm even in a meeting, having a conversation with someone about their deal, I may come across, it might be or thought during that conversation about someone else's deal, so I write it down so I don't forget by the end of the meeting that I can have an idea for someone else's deal. But, read everything, write down ideas. And the other mindset is, in my business, don't take no for an answer and never give up, because, I have seen people, that may get 6 no's, and because they said the sponsor's not strong enough, the market's not good enough, it's too expensive. In our business, you only need to have one guy, to do the deal, and sometimes, you have to fight to find that guy for difficult deals, and we do difficult deals a lot of times. So you have to have the mindset of not giving up until you find that one guy, which is what we do. I mean, that's really it, really. I mean, it's just we're very tenacious, and getting our deals done, which is why we have a lot of repeat clients, and why a lot of deals we do are hard. A lot of times they're hard. A lot of times the deals we do are, other firms failed and we succeed. And it's mainly because, it's a big deal, and we want to make sure it happens. And we find out one guy from Hong Kong that wants to do the deal, which has happened plenty of times.
It's funny actually. I also learned that lesson when I was at the bank when I first came across Carlton. Was that some of these were really tough projects to sell. And
right.
It just takes one guy, doesn't it? It's just a numbers game, really. At the end 100%. Of the day, right?
The one guy that thinks he can make something out of it, or he can make it work, and
right.
It's really just that one guy. That's always been our motto. It only takes one.
Mm-hmm. Okay, second question: what has been the hardest lesson you've learned in real estate?
Time is a killer. Many times, deals that didn't happen because either the sponsor was slow, the investor was slow, because, the market changes, rapidly in terms of what people think psychologically about the market. So the longer you wait to close a deal, it can hurt you because people can change their mind, a bank, for example, Ozarks, they went, their stock went down 25% last week. So it changes the mindset of some lenders. Like, oh, wow, what's going to happen here now? So maybe we should be a little more conservative on our lending now. If you have a deal that didn't close, it could trigger some other bank to be more conservative and not do your deal. That happened to me actually in 2006 on a deal, to be honest. So it's on a condo conversion deal. And of course, the sponsor's lawyer wanted to wait till tomorrow morning to do his opinion letter because he was going to his cabin in somewhere outside of Atlanta. I mean, it's the most ridiculous thing I've ever heard in my life. We're supposed to close that afternoon. The opinion letter is all we need. Waited till the next morning. And the investors, had an epiphany or something. It's like, you know what? I think the market's getting over. He was probably right, by the way. It was 2006 when things were about to change. Yeah. The deal didn't happen because the investor the next day thought too much because he had more time to think about it. They thought he didn't want to do the deal. He didn't close. All because the attorney wanted to get to his cabin, early on Thursday night, and close on Friday instead of Thursday when we're supposed to close. That killed the deal. Ever since then, no excuses to delay it. That's our motto.
Send it now. I'll come and pick it up now.
Right, exactly, right.
No, tomorrow morning's too late. I'll come now. So you've also alluded to some investors who presumably it's their first time looking at real estate, right? They want to diversify into real estate. When you come across those folk, what is the advice that you give to them if they've not yet invested in real estate but are thinking of doing it? How do you advise for their first deal?
I mean, for the first deal, one has to be a very good sponsor who's running it day to day. You have a strong sponsor, someone has a track record. And, you have to do a deal for your first deal that, everyone thinks you can make a lot of money in real estate very easily. It's not so easy, and you can make a lot of money in real estate. You can also lose a lot of money in real estate if you don't know what you're doing. So to be safe the first time, or first few times, go into a deal, which is an existing deal, which has cash flow, lower leverage. Don't expect to make a killing, on your first deal. If you make, a double-digit IRR on your first deal, and you have, 7, 6, 8, depending on the city, cash flow day one, that's a great deal. If it's low leverage, I mean, that's what you should focus on the first time. Don't expect to become, quadruple your net worth off of one deal. Then and that's your chances of losing money in that scenario are lower. It's just and then you look at the location. It's a bigger location. I wouldn't do lower leverage in Pennsylvania, as they say. It doesn't matter if it's not a prime market.
Right. That's right. Well, we better not broadcast this conversation in that. Where did you say in Kentucky? I've never even heard of it.
No. I said we call it Pennsylvania. Like Pennsylvania, Kentucky.
I see. Pennsylvania. I see. Right. Exactly. Got it.
I'm thrilled that Michael remains open to syndicating at least part of his deals to individuals, and I'll keep you in the loop if and when he has any deals that he's willing to share. Fact is, having such high caliber, pedigreed institutional investors alongside you in a deal makes investing in Michael's deals at Carlton particularly attractive and worth looking at closer. Having the opportunity to partner with Michael's clients it's a true leveling of the real estate syndication playing field and a democratizing of the industry. If, of course, you'll forgive my mixing metaphors there. let's hope that Michael once again opens his doors to mere mortal investors like you and me, because if he does, you know as well as I do that there will be a flood to his deals, and he will, I am sure, be pleased that he revisited the idea. So stay tuned, and I'll let you know when Michael opens up opportunities for you. And in the meantime, go to the National Real Estate Forum website, nreforum.org/Carlton Group, where you can read the full show notes for this episode and to sign up for the news digest at the top of that page. Be sure to do that so you can be first in line when I start handing out all my free stuff once I rebrand the podcast. Again, that's nreforum.org/Carlton Group. Thanks for tuning in today, and thanks stuff once I rebrand the podcast. Again, that's nreforum.org/Carlton Group. Thanks for tuning in today, and thank you, Michael Campbell, the new CEO of Carlton Group, for taking the time out to record this podcast with me. Congratulations and good luck to you. We really look forward to staying in touch, to hearing what you're doing, and all being well, to being recipients of the opportunity to invest in some of your deals. Okay? Until the next episode, this is Dr. Adam Gower